we got to build a solid foundation first. Let's quickly break down the core rules of what GST actually considers a supply.
Now here's the cool part. Everything you need, and I mean everything, all boils down to just one place, Section 7 of the CGST Act. Don't think of it as some boring legal section. Think of it as your secret weapon, your master key for any supply question the exam can possibly throw at you.
For most normal transactions, for something to be a taxable supply, it has to pass a simple three-point check. First, it involves goods or services. Second, there's a payment, or what the law calls consideration. And third, it's connected to a business. All three of these boxes have to be ticked. So let's look a little closer at consideration and the business part.
First up, consideration. It's just a fancy legal word for payment. But, and this is super important for your MCQs, it doesn't have to be cash. It could be a trade, a service for a service, anything of value. And get this, the payment doesn't even have to come from the person who gets the goods. That's a tiny detail that examiners love to play with.
Next, we have the business test. It's pretty simple, really. GST is a tax on commercial stuff, so the deal has to be connected to someone's trade, profession, or business. If you're doing something personal, it's usually outside of GST's world.
And this example just nails it. Look, if Rishabh sells his own personal car, it's not a supply. Why? Because he's not in the business of selling cars. But when a car dealer sells a car, well, that's literally their job. It's their business. Same car, totally different context, completely different GST result.
Our shop owner gave away a phone for free. Based on our three-point check, there's no consideration. So, that means it's not a supply. Case closed, right? Ah, not so fast. This is where things get really interesting, and this is exactly what separates the top-scoring students from everyone else.
And the key that unlocks this whole puzzle is a concept called deemed supply. This is a really fundamental idea in GST. It basically says that in certain situations, the law will just decide something is a supply, even if, it doesn't look or feel like a regular sale at all. And here's the thing you absolutely have to understand. Deemed supply completely ignores the price tag. It's like the law says, I don't care that it was free, I'm telling you it's a supply. There's this very specific list of activities, and if your transaction is on that list, bam, it is treated as a supply, period. This was a total game changer from the old tax laws where consideration, or, payment, was everything. Now, this isn't just some vague guideline. Oh no, it is written right into the law. We're talking about Section 7, Subsection 1, Clause C of the CGST Act, and you have to read it together with Schedule I. That's the powerful combo that lays out all these situations. And trust me, for your exams, you're going to want to remember that reference. Okay, so we know what deemed supply is, and we know where to find it in the law. Now, let's dive into the first major trap that's just waiting for you in Schedule I. This one's all about the permanent transfer of business assets. So if you get a question on this, here's your three-point checklist. It's super simple. Number 1, was there a permanent transfer or disposal? Like, is it gone for good? Number 2, was it a business asset? And number 3, and listen closely, this is the big one, was input tax credit or ITC availed on that asset? You need a yes for all 3 conditions. If even one is a no, this rule doesn't apply. Seriously? That third condition about ITC? That's the killer. It's the knockout punch. The moment you see an exam question about transferring assets, your brain needs to go on a mission to find the letters ITC. If the question says ITC was not availed or that it was blocked, then it is not a deemed supply. Game over. I'm telling you, this single detail is where all the marks are won or lost. Let's make this crystal clear. On the left, we have our original laptop problem. ITC was availed, right? So, yes, it's a deemed supply. Now, look to the right. A company donates a motor vehicle. We know that under GST law, ITC on most motor vehicles is blocked. So what does that mean? It means that donation is not a deemed supply. You see the difference? It all hinges on that ITC. Okay, you've got the asset trap down. Ready for the next level? This one can get, well, a little confusing. We're talking about transactions between related parties and even more weirdly, between different branches of your very own company. This is all coming from Para 2 of Schedule I, and yeah, it's a bit of a mind bender. So first things first, what on earth does the law mean by related persons? Well, the simplest way to think about it is anyone in a position to influence someone else in business. We're talking about family, your boss, or different companies that are all part of the same big corporate group. Now, of course, the law has a very precise list. It includes people like officers and directors in the same company, business partners, and that classic one we just mentioned, the employer-employee relationship. The key takeaway is this. If a supply is made for free between any of these legally defined pairs, Schedule I just switches on automatically.
But that leads to a really interesting question, one that trips up a lot of students. What about your own company's branches? If your factory in one state sends goods to your showroom in another state, are they related? Well, the answer introduces an even more specific and important concept.
They're called distinct persons, and you need to burn that term into your memory for the exam. The key here has nothing to do with who owns the branch. It's all about the GST registration. If a single business, same pan, has separate GST registrations for its different branches, the law basically pretends they are separate people for tax purposes. They become distinct persons. And ding, 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 exam alert. This is a classic ICAI MCQ trap. They will give you a scenario about a stock transfer between two branches. The only thing that determines if it's a supply or not is whether the question mentions they have separate GST registrations. You have to read the question carefully for this detail. This table just lays it out perfectly. Let's say you have two branches in the same state. If they operate under a single unified GST registration, then moving stock between them is not a supply. Nothing to see here. But if the company chose to get separate GST registrations for each branch, that exact same stock transfer instantly becomes a deemed supply, and it's taxable. Now, let's just quickly zoom in on one specific related person scenario that pops up all the time in exams. Gifts from an employer to an employee. Here's the magic number you have to remember, 50,000 rupees. The rule is that gifts from an employer to an employee are not a supply, as long as their total value in a financial year is 50,000 or less. But the moment the value crosses that limit, even by 1 rupee, the entire amount becomes taxable.
Okay, let's just dive straight into a problem that feels like it's been pulled right out of an exam paper. So picture this. You've got a supplier, a buyer, and an agent stuck in the middle. Now, this agent, to help the sale along, gives a short-term loan to the buyer and, of course, charges some interest. So here's the million-dollar question. Does that interest get tacked on to the value of the original goods for GST purposes? Your gut might be screaming, no way, but the real answer is, well, it's a bit complicated.
But what's really wild is that this entire complex answer, it actually boils down to one single, super simple fact. It all hinges on one little piece of paper. Stick with me, and I promise I'll show you exactly what it is and how to spot it every single time. So, this specific trap we're talking about, it's all about something called a Del Creditor Agent, or DCA for short. Now, a DCA is a special kind of agent who not only helps make the sale, but also guarantees that the customer will pay up. Because they're taking on that extra risk, sometimes they offer credit, and that's exactly where all the confusion begins. So, let's crack this code together.
Now, Schedule I covers a bunch of different scenarios. Stuff like permanently getting rid of business assets that you've already claimed input tax credit on, or transactions between related people, like two branches of the same company in different states. But for our problem today, the one we really need to zoom in on is right here. Supply of goods by a principal to his agent.
And here's the key line. The law itself, specifically Para 3 of Schedule 1, calls out this exact transaction. When a principal sends goods over to an agent so they can sell them on their behalf, the GST law basically says, hold on, that's a supply. It doesn't matter one bit that no money has changed hands between them yet. It's what we call a deemed supply.
Okay, so now we've got our key piece of the puzzle. We know that some agent transactions are deemed supplies. So let's bring this new knowledge all the way back to our original problem about the Del Creditor Agent and that tricky interest charge. How in the world do we know if our DCA is a Schedule I agent or just a regular one? Well, the answer is kind of shockingly simple.
Here it is. The whole thing, the entire answer, it all comes down to one question. Who issues the invoice to the final customer? That's it. If the supplier issues the invoice, the agent is really just a facilitator, a middleman. But, and you need to hear this, this is the real game changer. If the agent issues the invoice in their own name, the law sees it as two completely separate supplies. First, a supply from the principal to the agent, and then a second supply from the agent to the customer. This one tiny detail changes absolutely everything.
And hey, don't just take my word for it. This comes straight from a CBIC circular that was put out just to clarify this issue. This right here is your exam day keyword. When you read a question about a DCA, the very first thing your eyes should be scanning for is the phrase, issues invoice in his own name.
That phrase is the trigger that tells you Schedule I is in play.
So let's walk through the first possibility. Imagine the exam question clearly states that the supplier is the one who issues the final invoice to the customer. In this case, our Dell creditor agent is not, I repeat, not considered a Schedule I agent. So what's the outcome here? It's actually pretty clean. The supply of goods from the supplier to the buyer, that's one transaction. The loan from the agent to the buyer, that's a completely separate service. This means the interest does not get added to the value of the goods. In fact, interest on loans is an exempt service anyway, so there's no GST on it at all. The supplier just pays GST on their goods. Nice and simple.
And now for the twist. Let's look at scenario 2. This time the question says the DCA issues the invoice to the customer in their own name. The second you see that phrase, a light bulb should go off in your head. This agent is a Schedule I agent.
And my friends, this is the major ICI trap. Because the DCA is now a Schedule I agent, the law looks at this whole thing differently. It sees the principal supplying goods to the DCA, and then the DCA supplying those same goods to the final buyer. And since the interest is related to that second supply, it has to be included in the transaction value. So the DCA has to charge GST not just on the price of the goods, but on the goods plus the interest. You can see how easy it is to lose marks here.
All right, have a look at this question on your screen. A company in Delhi sends its truck to its Mumbai branch for repairs. Is IGST applicable? Now this looks pretty straightforward, right? But believe me, this is a classic ICAI-style trap. So many students fall for this, and it's such an easy way to lose marks. What do you think? Do you have an answer in your head?
Okay, drum roll. The answer is B. No. No IGST is applicable. Now, if that caught you off guard, don't even worry about it, seriously. Because by the end of this explainer, you're not only going to understand exactly why, but you'll be able to spot these kinds of traps from a mile away.
Okay, so what is this negative list? Think of it like a bouncer at a club. Before you even get inside to the GST party, the bouncer checks your ID. The negative list is that bouncer. Before you start thinking about tax calculations, you check this list. If the transaction is on it, boom, you stop right there. No GST. End of story. It's an absolutely powerful tool to save time and lock in those marks.
And this isn't just a random rule, it's baked right into the law. Section 7(2)(a) of the CGST Act is what gives us Schedule 3. And here's the key phrase. Anything on this list is treated as neither a supply of goods nor a supply of services. It's like it's invisible to GST. The law just completely ignores it for tax. Simple as that.
Now here's a pro tip, and this is important. The negative list isn't just one neat little document. If you really want to master this, you have to know where to look. There are 3 places. First, there's Schedule 3, that's the main event. But then you also have specific government notifications and, for those really tricky edge cases, CBIC circulars. You need all 3 to have the full picture.
All right, let's get into the real meat of it. This is the danger zone. This is where ICAI sets its most clever traps, and honestly where so many students needlessly lose marks. So you're going to want to pay really close attention to this next part.
First up, exam trap number 1, services by an employee. Now, on the surface, the rule seems super simple, right? Services an employee provides to their employer during their job, not a supply. But oh, the devil is absolutely in the details here.
Okay, look at this. This comparison is exactly how ICAI tries to trick you. On the left, you've got a normal job, an employer-employee relationship. You get a salary for your work. That is not a supply. But here's the twist. On the right, ICAI will give you a scenario with, say, a consultant hired on a contract. That's not employment, that's a principal-to-principal deal. They're charging professional fees, not getting a salary, and that is absolutely a taxable supply. Getting this distinction right is everything.
All right, let's move on to exam trap number 2, sale of land and buildings. Now, we all kind of know that these are generally outside GST, but there's a massive but attached to this rule, a condition that so many students forget under exam pressure.
And here it is. This is the crucial condition. It all comes down to timing. It's a non-supply only if the entire payment is received after the completion certificate is issued or the first person moves in, whichever happens first. Think about that. If a builder gets even 1 single rupee before that point, the whole thing flips. It's no longer a sale of a building, it becomes a taxable supply of service. This is a classic spot where marks are lost. You have to check the timing of the payment in the question.
Okay, our third big trap, actionable claims. I know, the name itself sounds a bit confusing, right? But don't let it throw you. All it really means is you have a right to claim something you don't physically have yet, like the right to collect a debt.
So, the general rule is simple. Most actionable claims are not a supply. But, and you knew there was a but coming, this is where ICI lives. They don't test the rule, they test the exception. The law carves out something called specified actionable claims, and these are considered a supply. And what are they? It's all the stuff you'd expect. Betting, casinos, gambling, horse racing, lottery, and online money gaming. This is prime MCQ material. They'll give you a list and ask which one is a supply. You have got to know these exceptions cold.
Okay, so a good student knows Schedule 3 inside and out. But you know what a great student knows? They know the list doesn't stop there. The government can actually add more items to this list using notifications and circulars. And if you want to be prepared for anything, you need to know about these too.
Here's a perfect example that comes from a notification. When a state government grants an alcoholic liquor license and they charge a huge fee for it, that service is specifically treated as a non-supply. Now, this is really important to remember because normally, services provided by the government to businesses are taxable. This is a very specific carve-out.
And now we come full circle. Remember that truck from our very first question, the one going from Delhi to Mumbai for repairs? Well, the answer wasn't hiding in Schedule 3. It's actually tucked away in a CBIC circular, which is exactly why it's such a great exam question.
So here's what the circular says. The movement of conveyances, things like trucks, trains, planes, between two branches of the same company, what we call distinct persons, for reasons like repairs, that movement is not a supply. So the trip itself, ignored for IGST. But, and this is a critical distinction, the actual repair service that happens in Mumbai, oh yeah, that is a totally separate supply and it is 100% taxable.
Whew. Okay, we have covered a lot of tricky ground. So how do you actually use this information when the clock is ticking in the exam hall? Well, I've got you covered. Here is your final exam-ready checklist.
So before you even think about calculating a single rupee of tax on any question, just pause and run through this mental checklist. Ask yourself these 4 questions. This simple little process will be your superpower. It'll help you spot the non-supplies, sidestep the most common traps, and grab those crucial marks that, trust me, other people are going to miss.